All right, so we have a little exercise here titled Computing Net Income. Move this down just a bit here. Let's see what we've got. Okay. So Healy Corporation recorded service revenues of $100,000 in 2018. And it says of which $70,000 were on credit and $30,000 were received in cash. Moreover, of the $70,000 credit sales for 2018, it collected $20,000 cash on those receivables before year end. The company also paid $60,000 cash for 2018 wages. And then they say compute the company's net income for 2018. So it's very important to realize a couple of things here. Number one is that we only have revenue and expenses as far as we mention accounts receivable up here, but that's a balance sheet item. So the only operating expense we have is cash wages. All right, and it says the company paid $60,000 cash for 2018 wages. All right, so they recorded service revenues of $100,000, and they had, I'm assuming that they didn't have any more than this. We had a wage expense of $60,000. Well, that's the only information that we have, so the answer is $40,000. All of this other information is irrelevant. It does not matter that $70,000 was in credit and $30,000 was in cash. The fact is they've earned $100,000, and so under the basis of accounting, we are going to record $100,000. The fact that all of this was not collected within the year is completely and totally irrelevant. So all of this extra information is only going to serve potentially to confuse you. So the answer is $40,000. $100,000 in revenues minus $60,000 in expense gives us the $40,000 in net income. Not exactly a realistic scenario because we have generally more than just salaries expense. However, it's possible if we were working out of our house and we brought our employees in, we wouldn't have any rent expense or delivery expense, and the customers just drop off whatever it is they're doing to us. So again, not a realistic scenario, but we're trying to keep this simple so that we kind of understand just the basics. Okay. B, it says, suppose that you discovered that employees had earned an additional $10,000 in wages in 2018, but this amount had not been paid. Say, for example, it's going to be paid at the beginning of January. Would net income change? Well, they want you to just mark this, and the answer is yes, it absolutely would change. And by how much? Let's see, use a negative sign if the answer decreases net income. So it does, so we're going to do that, negative $10,000. So again, same story. This is the accrual basis of accounting. So the fact that wages had been earned is what matters. Okay, so what we really have going on now is $100,000 in revenues minus $70,000 for wage expense. We recognize wage expense not when the cash goes out. Now, that's what it looks like right here, the way this is worded. But instead, we recognize wage expense or salary expense when that expense is incurred, okay, not when paid, under the accrual basis of accounting. So if the scenario was $100,000 revenue, $70,000 in wages that had been earned by employees, but our net income would change to $30,000. $40,000 minus the additional $10,000.